Good evening. My name is Brad Olson, President of Oaktree Financial Services. I'd like to welcome the attendees we have for our economic update. We do these on a quarterly basis to just give everyone a chance to hear a little bit about where we think the economy is, some things that we should be looking at, areas of that are positive and areas that may be negative that we're going to talk about when it comes to looking at overall asset management. One of the areas that we focus on are the facts, try to leave emotion out of the formula as much as possible and look at really where the numbers are of what's driving our economy and in general, how that's going to affect your portfolio. So I'd like to welcome everyone here this evening. Just a few housekeeping items. First of all, we're in Brookfield. Always feel free to stop by. We're at 13555 Bishop's Court, and we'd love to have you stop in. And I know a lot of our clients come in for their reviews, but if you're not a client, we're easy access right off of Blue Mountain Road. Now, I do want to let you know that we are recording this. We do record this and put it on our website to make sure that people that can attend get a chance to hear what we're talking about when we do our economic update. So just to let you know, it is being recorded. Also to let you know that there will be a chance to ask questions as we go through here. But as far as our agenda, we're going to keep this right around 45 minutes is our goal. We're going to do a brief update of things that are going on at Oaktree. We're going to talk about the business cycle. As you've probably heard over the years, if you are a client, it's the main driver of how we position our portfolios. We're going to talk a little bit about what happened in the fourth quarter. 2020 now is in the rearview mirror. We'll just touch on it quickly. Then we'll talk about what we see for 2021. Alfred Hickey, one of our advisors. Alf is a CFA. There's Alf. He just said hi. He's going to be talking a lot about international investing. One of the areas that's been a bit in the doldrums over the last 2-3 years and hasn't cycled through yet has been some of the international side. We started to see that have a nice run. And Alf will kind of talk about what we see in the future on the international side with a little more foreign exposure. So that's going to be our agenda. Now, one of the areas that I would just want to briefly touch on, I'm not going to do this very long, but talk about what's going on with Oaktree Financial Services. First of all, for our clients, a lot of you have received our client experience. We sent that out talking about what our number one focus with going forward in 2021 is really solidifying and putting together a client experience for our clients to make sure that we're communicating and communicating the way that you want, not just the way that we do it. Because everyone has a different way that they like to have us put things out to them, whether that be through emails, through phone calls, through face-to-face, through webinars now, or a combination thereof. But we will be talking about what our commitment is to our clients as far as reviews, the communication, the financial planning, all the things that we do. Just a quick note, Mike Radishell, one of our advisors, and Mike and I have been together for over 10 years. Mike is in retirement, although still a consultant, and we still have access to his expertise and to touch base with him on occasion. He's now in Arizona for the winter, but we talk pretty much on a daily basis. But Mike has been a great companion of mine over the last 10 years and of this firm. We're going to be updating things like beneficiaries and trusted contacts, figuring out the best way to contact you. We've been putting a lot of focus on what I call GRIP, our Guided Retirement Income Planning. As we go forward, we're trying to get our clients and people who are coming in to see us to look at ways that we can make sure that your retirement is going to be what you want it to be. And it's never too early to start that planning process. So we really are making sure that we're focusing on making sure your income and your goals and what you want to achieve are being set up so it's going to be there when you need it. The last point I'm making here is it's been a interesting year with COVID. It's kind of changed a lot of ways we do communicate with our clients. I know I'm actually teach a class. I haven't been able to do that. There's a lot of things that we've not been able to do because of COVID, but also there's a lot of things that is really like with these webinars, something that we are using more as a tool to communicate with a lot of our clients. So I think in every adversity, there's things that come out that are positives, and that's been some of the things that we've seen with this. Hopefully, the adversity will stop here soon as we go through the vaccinations and through the process and some of the announcements we had today from the new administration of ways that we'd be addressing the whole COVID situation. We have a poll question that's coming up, and while you're looking at this poll question, I'll talk a little bit about our GRIP. Really what we're looking at here is how many times have you been to our website? We'd like to have your input on that. but it looks like several people have been to our website, which we find to be great. So we appreciate that. And as we're going forward, we want to use that as a communication tool. And again, I talked a little bit about GRIP. We will be focusing on that as we go forward. But let's get started talking about some of the economic things. First of all, I'm going to talk a little bit about what's going on with the investments in the business cycle. As a client of Oaktree Financial Services, one of the things that I've always talked to people about, if you've been with us or you're thinking about coming in to talk to us, is really it's a three-phase process that we look at. First of all, we determine your risk tolerance, what your goals, what your time frame is, how much volatility can you handle. A lot of people are very different in that standpoint of how much risk they're willing to take. What I mean by risk, how much up and down are you willing to see your portfolio fluctuate? So we look at that. We really define what your risk tolerance is or what your profile is. Then we determine second, which I'm going to spend some time on this evening, is talking about the business cycle. Where are we at in the business cycle? Because where we're at in the business cycle is going to help us determine what are the allocations that we should be looking at to take advantage of where we're at in the business cycle. What you're going to find when you're in investing, wherever we're at in the business cycle, there usually is some place to put your money besides under the mattress. What we're looking at is we're looking at ways that we can make sure that, again, we're not going to go all or nothing, but what we're doing is make sure we're putting the probabilities of success on our side by figuring out where we're at in the business cycle. So what we do after we determine your profile, we determine the business cycle's profile, then we put those two together and determine your allocation. So that's a very important process when you're going forward. That's why when you're looking at investing, we try to break it down to the facts. What's going on with the indicators? Now, emotion can drive the economy in short bursts, but what happens is over a period of time, you're going to see it's going to be the logic of where we're at that is going to make a difference. So that's why we caution people not let emotion be your driver. Let the facts be your driver as far as your investment portfolio. I want to talk a little bit about what we saw in the past. One of the things that we're looking at when we look at 2020, what happened in 2020? First of all, a very volatile year. I'll touch on that in just a second. But we saw the Dow Jones Industrial Average up about 7.25% last year. We saw the NASDAQ up almost 44%, driven by a handful of stocks. The S&P 500 up 16%, again driven by a relatively small number of the 500 stocks. We saw bond yields end the year at around 0.93, which you did see a year ago was 1.92. What we've seen as far as the quarterly change, we've seen a change in the rate environment where it's still pretty attractive from a rate standpoint. Now, one of the things that I was trying to make people understand is 2020 was a huge year as far as volatility goes. One of the things I've been looking at when I've been looking at our clients' portfolios is what happened from January 1st to March 22nd. What you saw is it was really an event-driven situation with the virus. What you find is when you see your portfolios, what we call a bear market, where we have a pretty good sized decrease of 20% or so, what you're seeing when you have a bear market, it's going to be driven by three things. It's either going to be cyclical, which is the business cycle, which we're going to be talking about. Inflation comes into play, the Fed raises interest rates, they slow the economy down, can cause a bear market. It can be structural. Like structural is what we had in the 2008, 2009 downturn, where what we saw that it was driven by a structural defect in a sector, actually the mortgage situation, where we didn't know where bad mortgages were. Because we saw the huge appreciation in housing. We saw people taking mortgages on those houses. Those mortgages were put in derivatives and put in a lot of other types of holdings, various bond holdings, and we saw that we didn't know who had them. So that was really a structural bear market that we had. This was what we call an event-driven. Now, the good thing about an event-driven with the virus that we had, the one good thing is usually event-driven downturns are relatively small. So once we determined it was event-driven, what we found is the period of time that you see the downturn is usually the shortest. So it's the smallest of the three different events. On an average, when you look at a cyclical downturn, which is basically driven by the business cycle, usually that takes about 50 months to recover. When you're looking at structural, that can take up to 100 months to recover. When you're looking at event-driven, you can see that be about 15 months to recover on an average. So what we find is when we look at how long it takes to recover, we find that usually this is the shortest. Now you see from January 1st to the 22nd, the S&P, again, the S&P is just an index. I don't want to overstate that as some biblical thing that we have to look at. It's just 500 stocks that are put in an index that a lot of people know about. That's why I use that. That went down almost 29%, 28.66. Now, the good news is we had a quick recovery. From March 23rd through the end of the year, we saw the S&P go up 41%. Now, overall, that's where we derived the 16.26. I need clients to understand, and I think consumers need to understand, or investors need to understand, that that can happen. You can see fluctuations. I mean, from peak to trough back in the 08-09 period, we saw the markets go down some 57%. So if you were all in the S&P 500 from the peak to the trough, you were down 57%. Your holdings went down. Those are pretty big dollar amounts. So just keep that in mind. When you're invested, you do have an element of risk. Now, the good news is that we can gauge and control to a degree how that works. And you need to understand, you should always know what your risk factor of your portfolio is. So who's ever managing your money, if you ask them that question, they should have an idea of what your risk factor is in your portfolio. But I think this is a chart that really illustrates, to me, what real risk is. And this year really showed that. Now, as I mentioned, I spend a lot of time talking about the business cycle. And really what we have is we have 4 phases of the business cycle. And when you think about it, it is relatively simplistic is maybe the wrong word, but logical. There's a lot of factors that go into this, and this chart makes it look fairly simple. But what you have is you think about how business cycles work. One of the number 1 criteria that we have, and you'll hear about the Federal Reserve, is to control inflation. If we see the economy accelerating, where all of a sudden we're seeing the economy accelerating up quickly, and we're seeing that all of a sudden there's a lot of flow, GDP is way up, that's great. But what that does do is it does put pressure on inflation, because what you'll find is you'll see that overall, when we're looking at the markets, what we're finding is the inflation is being caused by the demands for goods and services. So if there's pressure on wages are going up because there's a demand for labor, if there's a demand for commodities to make things, what we see is all of a sudden that starts coming into inflation. What the Fed's going to do then is they're going to raise interest rates, which starts these cycles going. And then also you can have cycles driven by event-driven or structural events too, where it accelerates or decelerates some of the things that are happening here. So it is important that we do understand what's going on in the business cycle. Now, we estimate the current business cycle may be moving into phase 2, and I talked a little bit about that. And some of the things that we're going to be talking about is when you get into this phase 2, the economy is still improving, interest rates start to bottom, then they start to rise, inventory to sales ratios decline. So basically what you see is you see that we start using we start seeing inventories being used, and we start accelerating production to try to fill those inventories. And what we see is then that maybe drives inflation. Now inflation bottoms and about this time, and we've seen that maybe happen. Labor costs begin to creep up. Now, a lot of this though has been affected by the virus. When we talk about kind of where we're at overall right now, the virus has had a big effect, but we have had a nice recovery where we have seen that people have been spending somewhat, although there still is a logjam. Now, the good news is we have seen that inventories overall, and I'm going to talk about some of these things, have decreased. We don't have a lot of inventory because there has not been a lot of producing of things. There's a backlog of things that people do want to buy right now, and especially once the virus and we start to see that there's vaccines for that, what's going to happen is we are going to see that there is going to be more of a demand. Now, as I mentioned, I thought this was interesting because this kind of shows back where we were at in 2018, back where we were heading into 2000, when we came into 2020, we were starting to see that we were getting, and then we accelerated up into this here. We saw that we were starting to see the markets accelerate back into phase 2, where we bottomed very quickly with this virus that we had and what's happened. We are starting to see some acceleration. I'll talk about some of these things in just a second. So one of the areas that I wanted to put in context, so why this is so important, this is a chart that shows if we have a moderate investor, say normally we score you and we sit down, we talk with you, we determine what your risk tolerance is, and we determine that all things being equal, in the middle of a business cycle, you're about a 60-40 mix of equities to bonds and cash. Now, what happens as the business cycle accelerates or decelerates, we do adjust your mix. I'm not a big believer in saying you allocate and you stay at 60-40 for the rest of your life. That's what some of these programs do. If you're a programmed investor, if you're in a lifestyle fund, they basically stick to a certain mix because that's what it determined you should be. We feel that you should add a thing we call alpha, which is meaning add return to your risk that you're taking. So you actually get more return for the risk you're taking. And that's where we feel that if we adjust the portfolios and take advantage of what the business cycle offers, we can do that. Also adjusting which sectors may be more advantageous at that time. One other poll question we have is do you use our Facebook? As we go forward, we want to find out if people are using our Facebook. It is something that we are looking at more and more. Are people utilizing these types of things? We do post a lot of stuff to Facebook. If you do utilize it, we'd be, I hope you do. We're trying to use these types of resources more and more as we go forward. Let me close this down. Next, we're looking at, as far as the fourth quarter review, I'm going to talk a little bit about kind of right now where we're at. First of all, I'm not going to spend a lot of time on each one of these slides. They can be a little overwhelming, but I do want to highlight a little bit of what's going on with the housing sector. This has been a big plus that we've seen even during this virus. I don't know if anybody sold a house or anybody's bought a house that's on the meeting today, but if you have, you find that these happen pretty quickly and people are getting more than asking price. One of the reasons for that is interest rates have been extremely low and people have been taking advantage of that. So we have seen a nice increase in existing home sales and also new home sales. Now that's a positive in a couple different ways. Existing homes, people make improvements, that accelerates into people working, and we've seen the Home Depots of the world and the Lowe's. It's been a pretty good year for them due to the fact that they've seen a lot of people doing that. Plus people have had some time if they have the money to do it. New home sales, a lot of people work through that process, whether you be a plasterer or a rough carpenter or whatever you are, you see that that helps the labor market that way. So that has been a plus. Now, I put this a little bit on the neutral side right now because I am starting to see a little bit of a decline in that indicator. So when I'm looking at my indicators and kind of scoring them, this one still strong, but has slowed a little bit. The question is how many houses can a person buy or how many changes are a person going to make? The second one are the consumers. When you're looking at our economy, about 2/3 of it is consumer spending. So this is a very important situation that we look at. You can see, if you look at the blue line, which is consumer spending over here, what we find is we found that we had a big drop in consumer spending, fairly logical. First of all, we couldn't go anywhere. We were pretty much locked in our basements. So what happened is that we couldn't spend money even if we wanted to. Now we have seen that there has been a thawing where we've seen consumer expenditures come back quite a bit from where they were. Also, we've seen that personal income drop dramatically. Now we have seen a bit of a rebound in that and a bit of a pullback as we've kind of played with this virus. As things look like they're getting better, we saw the numbers increase. And that's something I'll talk about towards the end of the seminar. We still aren't out of the woods yet. Now, again, hopefully we are seeing the case numbers as of today start to decelerate a little bit, and hopefully that will be the case as we go forward. Purchasing Managers Index is something I've watched for decades. It really tells us from a purchasing manager standpoint, really what their projections are, what are they planning on buying in the production phases that they're in. What we've seen is we have seen that we are rebuilding inventories. or we need to rebuild inventories, and we're starting to do that a little bit. So we are seeing the PMI numbers, which really cratered here. I mean, that is really a low number, by the way, to be down in that 35 range. That's back to where we were in that 08, 09 period. But that blip was fairly short-lived. You can see we're back up to a 57 on the purchasing managers and kind of what they're looking at and how they're feeling of what they're planning on purchasing as we go forward. That's a good number. That's a plus number. As far as commodities, we have seen lumber has curtailed a little bit. The main reason is the housing market has curtailed a little bit, but we have seen things such as copper and the demand for oil. Now, again, this is a whole different subject that we could spend some time on. I mean, the question is, how is that going to change? I mean, the new administration has some different thoughts on how we're going to produce our energy going forward. And what is that going to do to that whole market? Well, time will tell. I mean, we're trying to digest that and figure out what options. But overall, we have seen that commodities, which again is good because you think about it, if commodities are being used, they're used in the production of goods and services. We've started to see that accelerate and come back from the depths it was down when you saw back in here. So when we're looking at it now, inflation is still relatively low. If you look at the inflation numbers, basically the broadest measure inflation rose 1.1% year over year. So inflation is still under control. So that's one of the areas that really lends us to believe that as we go into 2021 and through 2021, there is some opportunities for us to see the markets probably give us some advantages as we go forward in investing and inflation. Because remember, the Fed's #1 goal is to control this inflation number. Bond yields, we have seen bond yields come down. They've started to spike up just a hair, still very controlled. We are still seeing that, if you're a CD buyer, the rates are still pretty low. If you're a bond buyer, the rates, and especially high quality bonds like treasuries, are still relatively low. This is an area that we are watching closely to make sure, because this is going to give us some indication as we look at inflation, especially the higher yield bonds as we go forward. US dollars weakening should be good for the whole import theory as far as our exporting out, because countries can buy our goods with less of a cost. We'll talk a little bit about that later on in the international side, but we have seen the dollar weakening a little bit. Credit risk is something I watch coming from a banking background. We have seen that the risk to lend money is still relatively low. There's a good money supply out there, especially as we start doing the stimulus. So it should allow businesses, once they can and once they realize where we're going as far as the overall pandemic, it should allow us, as long as interest rates low, to see that money will flow into that and be ready to be deployed once that happens, especially with some of the things we're looking at doing from a stimulus package. Now, one of the areas that I like to highlight is, and again, this is designed not to scare anybody. It's really designed to show you what's happened in the past. But I do want you to understand what risk is. If you look at our markets, and again, a lot of us have been around for this period of time and have had money invested for this period of time, you saw basically the tech bubble, where we saw us go down here. You saw the whole mortgage derivative markets. You saw us go down here. Then we had the event-driven situation that we had. We saw a 34% decrease there. So in the last relatively short period of time, we've seen a 49% decrease in the S&P. We've seen a 57%, and we've seen a 34%. Now, the good news is if companies keep earning and come out with goods and services that we want to buy, and we are a growing economy, which we are, we have seen it overall, it's been a positive. But this is risk. And if you're going to be invested, it's something that we do have to figure out, we do have to protect against. And we're always going to talk about benchmarking risk. Because one of the areas that we look at is I have a tendency to always look at what the price to earnings ratios are. And again, it's kind of interesting. I've been in this business a long time, and everybody's always trying to recreate kind of what's important. So our P's, one of the articles I was reading today was talking about our PE still important. Yeah, I believe they are, because the bottom line is the price of a stock to the earnings of the company. It's a relatively simplistic idea. For the market capitalization of a company, what are the earnings of that ratio? So when we look at it right now, we're running at right around 22.5 is our price of our stocks, the outstanding stock for a company, based their earnings. Now, historically, for the last 25 years, that's been around 16.5. So you can see our numbers getting a bit high. Now, when we look back, you look back at when I talked about the tech bubble, we were seeing numbers at that time in that 28 range. That was a very high PE ratio that we had. Now, when we had the downturn here, when we looked at that 08, 09, 07, 08, 09 period of time, what we saw is the good news is we went into that without PE ratios being extremely high. So it did allow us, even though we went down quite a ways, I think it did help our recovery being fairly quick due to the fact that what we saw that the PE ratios were not overstretched going into it. Now, if a person asked me the other day, what worries you in 2021? Well, it's relatively simplistic. The pandemic continues to worry me. Our PE ratios, I think certain stocks especially are on the upper end of the PE ratio. So what's going to happen is either you're going to see their earnings increase to justify the price of the stock, or you're going to see the stock price come down. Or the third alternative, maybe they're a growth company. If I come out with a new product that has a lot of opportunity, Tesla is a good example. And I always will talk to people about Tesla because everybody says, why aren't we in Tesla? And some people are, but overall, it's a riskier venture because basically you have a PE ratio that's astronomical because you're betting on the future of that company. Now, one of the reasons why that's been very volatile, you have a fairly volatile leader of the company. And plus, are they going to be the main driver when all the dust settles on the electric cars? The bet is yes. I mean, the bet is a lot of people are saying yes. We feel that Tesla will drive that marketplace, whether it be the battery marketplace or the overall just the electric car marketplace. So what we see is you're willing then to pay a higher price for a stock like that because it is truly a growth company. So those are things that we have to look at, but always you need to understand, again, eventually everything comes down to earth to justify their pricing. Because if companies don't make money, eventually they're out of business. It's just the way the world works. You give them a lot of latitude, and we saw that back in the tech bubble, but eventually you shake out the ones that will and the ones that won't, because eventually you have to deliver earnings for the company stock. Now, overall, we are anticipating that the earnings per share ratios will be logical as we go forward. We are starting to see operating earnings increase a little bit, which is good. And depending on when the virus and when the various antidotes that we have coming out help, that can accelerate this. So the key is we need to see that being delivered. Now, the earnings that are coming in that we are seeing are pretty positive so far. I was looking over some earnings reports before this call, and we are starting to see that the companies are delivering kind of the numbers we expected. Doesn't mean the stock prices are going to go through the roof, because you can meet expectations and not see your stock go up. But it does really justify that we are starting to see the earnings start to go up. I'm not going to spend a lot of time on this chart, but I do want to mention one of the things that we saw last year was a lot of the return of the S&P 500 was driven by a small number of the stocks. So when we looked at it, we saw that basically a small number out of the S&P 500 stocks were driving a lot of the return. When I looked at this early December of last year, we were seeing that basically 10% of the stocks, around 48 it was, out of the 500 were driving about 90% of the total return of the S&P 500. And we're driving a lot in this thing. The top 10 stocks are weighting over 28% of the weighting of the S&P 500 capitalization. So what this meant was last year, remember I showed what the Dow and the S&P did? Remember the Dow was like 7.5, S&P at 16. Again, it was definitely not what I call a dartboard market. We just throw a dart and everybody wins. This was basically what we look at. It was a market that it was kind of certain stocks did appreciate fairly quickly. Some of your Apples, your Teslas, things, Microsoft. We did see that those did accelerate, and a lot of it had to do where we saw the opportunity in the marketplace with the virus that we had. So just don't think last year, because of the returns you saw, was every portfolio, because unless you were you saw that your portfolio was very structured to be in just a few things and you were taking a lot of risk, that's not the way it was. And we do practice asset allocation to make sure that we do not have all our eggs in one basket. And if you do that, probably didn't see the returns of what you saw exactly with the index. And so it was definitely a very concentrated returns. Again, just to talk about, I want to spend a second talking about volatility again. Just be aware, if you're invested, you will have volatility. This is not the last time and is not the first time. It's going to happen on an ongoing basis. That's why one of the things we are talking with a lot of our clients about is making sure you understand the risks that you have in your portfolio, and we understand the risks that you have in your portfolio. Doesn't mean you shouldn't take it. You just better understand it and be comfortable with that. Now, what's interesting in our business, I've been looking at a lot of different kind of investment vehicles that are coming out, that and it's kind of interesting. One thing that you'll find in our industry, you will have providers of various products that do take advantage of what the market is asking for. We are seeing products now. I was looking at ETFs that have upside limitations, but downside protection. It's kind of a unique concept that I've found out there. And for certain clients, I'm going to mention it to them because I think it's one where a lot of people are saying, I've gotten to a certain level in life, I just don't want to get clobbered. And I can tell you, if you're all in the S&P 500, you're going to get clobbered, just the way it works. There's going to be another event driven, there's going to be another structural driven, there's going to be another cycle. It just is going to happen. How deep it's going to be, no one knows. But be aware that this is not the last time that that's going to happen. COVID, when you're looking at the COVID numbers, the reason I put this out is due to the fact that it is a big driver of what's going on right now. When you look forward, now the good news is we are starting to see the number of cases starting to slow. And actually this chart is a little bit old, maybe about a week or so. We are starting to see that those numbers, this is January 11th, we are starting to see that those numbers are coming down. Now, that doesn't mean that they're going to stay down, and we are anticipating some peaks as we get through the winter months and start getting into spring again. We may see things accelerate. A lot of this depends on how fast we get the ability to get out the shots and be able to get people protected as we go forward. But once we do see that this isn't such a big problem, we do see some good opportunity as far as the business cycle goes. I know I was getting a lot of questions on the budget. When you're looking at what's going on with the overall markets and what's going on with the budgets. Right now, when you're looking at our percentage of GDP to our debt, we are starting to see that it's some things as a percent of GDP, it is getting a bit high. Now, the question is, will we see our GDP increase enough to bring that number down? A lot of the money that we're going to be spending, how much is that going to increase our debt? If interest rates go up, how is that going to increase our debt because of our debt servicing that we have? Right now, are we worried about debt? Sure, always worried about debt. If you don't balance your budget, eventually it's a problem. I mean, I did some looking at some of the other countries throughout the year, that we've seen. I mean, one of the things, now it's going to talk about this when we get into international. You've looked at Japan over the years. I mean, Japan's debt ratios have been interesting. What happened is we've not seen much acceleration in their economy for a long time. History does show us if a country does not control their debt at certain ratios, that what happens is you're going to see a very stagnant economy as we go forward. So, even in Europe, I've seen that basically when I've looked at Europe, and again, Elf will talk a little bit about this, Germany has pulled a lot of the EU up from that standpoint, where we've seen that, their economy has been relatively controlled as far as debt to a large degree. What happens is it is something we are concerned about, but it's not a panic point. Honestly, I wrote an article the other day and I said, my major concern is probably for my grandchildren and my children, what's going to happen with how are they going to have to deal with this debt. Now, if we do see an increase in taxes, we are going to see an increase in taxes. How will that help? If we see an increase in GDP coming out of this downturn, that will help those ratios. So it's not something that you just want to say, okay, debt's always bad because we're going to have it. It's something we do have to look at. Now, another poll question we have, and we appreciate your input on this, is what are the, what are you looking at as far as other webinar topics down the road? If there's anything that you'd like to see, we're always looking for input either here or let us know. We do a lot of different topics that we cover. We're going to do webinars in a couple different ways. One is we're going to have them like what we're doing, but also we're going to do webinars and also have them live too. Downstairs, we have a great conference room. So for people that want to come in and get more of a tactile experience of being in a room with us, we'll be doing it once we can again. So we do want you to know that your input is kind of what drives the things that we do. So let us know what you'd like to see. Close the poll down here. So as we go forward, now what I'd like to do is Alfred's going to talk a little bit about international investing. Go ahead, Alfred.
Thank you again, another advisor at just give me a little message that my connect it's working.
Are you okay there, Alf? Yeah.
Can you hear me, Brad, now?
Yeah, I can hear you.
Yeah, I think there's just a little hiccup in the
Connection?
internet right there. The message that was unstable. Yeah. So I'm Alf, certified financial analyst that works with Brad and everyone else at Oaktree. So I'm investing. So this is an interesting topic because over the last decade, it has not been a popular thing to invest internationally, but we think that this may be changing going forward. So why should you invest internationally? Get this going. So the main reason theme that you hear from for all different kinds of investment that you want to diversify investments. This is why indexing is popular. And so international investing gives you some unique diversification benefits that you don't get from anywhere else. So these benefits are, it diversifies political risks. So this is like in a country like the US or in Europe or something like this, there might be a political crisis. These are usually more economic. You know, I think that the past month might be a political risk, but really, as far as markets go, it didn't affect them that much. What really affects them is things like a debt ceiling shutdown or budget not being able to pass, something like that. But in other countries that are more developing markets or that are more emerging, like say China or Thailand or India, countries like that, there might be some more serious political problems. And if you invest all over the globe, you can diversify away from those. And also there are local economic cycles and bubbles. So a very common one is a housing bubble. So you have a housing bubble in one country and not another country. And by investing all over the world, you can you know, having all your eggs in one basket. And another thing, which isn't really a risk, it's more of an opportunity, is technological change. So you don't really know, you know, where the hot new tech company is going to be, especially, you know, going forward. I think it's not going to be so focused in Silicon Valley. It's going to be all over the world. So a good example of this is Taiwan, which is now the dominant semiconductor of making silicon chips. And, you know, if you said 30 years ago, they probably would have been like, Taiwan, why are they dominant in that? But now, you know, the 2 out of the 3 main semiconductor companies are based in Taiwan. And you want to avoid home country bias, which has been, in people who study this happens all over the world, is that people invest more in their home country than they theoretically should based on principles of good diversification. So this is an example of some of the benefits of diversification. So this shows that similar countries, one in the US and one outside the US, and it shows the measure of correlation. So that's a measure of how much the stock will go up and down with an index, in this case, the S&P 500. So a lower level means less correlation and more diversification benefit. So you can see General Mills, the big American company that's a consumer staple, is correlation with the S&P 500 is 55%. Well, Unilever, which is a similar country, is only 30%. You can see similar things are true with General Motors and Honda, and Oracle and SAP. So this you can really see that even though these are big multinational corporations that do similar things, they do have different trends in their earnings growth and things like that than purely American companies. So you do hear some people say that international investing is not worth it. So we'll kind of address these. So the first one is kind of like related to the slide that I just showed you. So if the economy is globalized, where big multinationals invest all over the globe, does it really give you diversification to invest abroad? And as you saw from the slide, that it really does. Even though, you know, a company like General Mills will try to sell over the world, it just doesn't have the same kind of international benefits that investing in a true foreign country does. Another thing that people say is that there's more political risk in emerging markets. This is definitely true, but like Brad was saying before, there's no reward without taking risk. So even though there may be more risk, there is more potential for reward. And as long as you set your portfolio up correctly and are diversified, to be able to take these risks, this can be very beneficial to you. And as far as developed markets, so that's mostly in Europe and Japan, the US, especially over the past 10 years, has had a lot more growth than they have. And this has definitely been true for them, but as we'll see, it hasn't been true for the past 50 years. And there are reasons to think that the growth levels might start to coincide over the next 10 years. And another problem that people often bring up is exchange rate risk will be added to the equity risk. But as we'll see in the next slide, as long-term investors, this doesn't matter that much. So here you can see this is periods when foreign currencies have boosted stock returns, or when they've hurt stock returns. So when it's positive, they've helped, and when it's negative, they haven't helped. And as you can see here, it's pretty much just a random up and down. If you average this all out, it's pretty much nil. So as most of our investors are invested for the long term, it doesn't really make sense to pay too much attention to foreign currency risk. And then this, I think, is probably the most interesting slide. So this shows when investing in foreign stocks have outperformed the US stocks, and when international stocks have underperformed the US. So as you can see, it's not like the last slide where it's kind of randomly up and down. There's these broad cyclical trends. So you can see from 2010 to 2019, that was a period of underperformance for foreign stocks. But you know, from 2000 to 2008, there was a big outperformance. And you can see it just kind of goes up and down in a cyclical fashion, where there's these pretty strong persistent trends. So as the economy, the global economic cycle looks like it's entering a new phase now, this could be another portion like 2000, where foreign stocks outperform. And you know, as Brad said, there's things like PE ratios that suggest this might be true. So we think that this is a good time to really start looking, because if you can get right in the beginning of the trend, it can be really helpful for your portfolio. Then related to that is that recent performance has been bad, especially over the last 10 years of foreign stocks. So this has mostly been a combination of two different things. So in Europe and Japan, the developed markets, they have grown much slower than the US. This is largely related to fallout from the 2008 financial crisis, where they you know, were kind of recovering from that. There was a lot of debt. And then in emerging markets, it was a similar problem, where there was a debt overhang and the emerging markets weren't taking that much imports. So they were also growing more slowly. So will this continue going forward? So 2020 was a strong year. The foreign stocks, not including the US, gained 10.7% on the year. And a very important thing is that interest rates are going down in the US. And these are matching more of the interest rates in Europe and Japan, which should mean that the growth levels are also going to be more similar. So if you look at a very long term, so from 1950 to 2019, almost 70 years, you do see a benefit from investing globally, and this is the benefit from diversification. So if you have a pure US portfolio, the annualized returns are 11.3%. An international portfolio does slightly worse at 10.3. If you did a balanced portfolio, 70% of the U.S. and 30% international, you actually equal the returns of the U.S. portfolio at 11.3%. So this is possible through diversification, and you actually reduce risk. So the standard deviation is a measure of risk. So you can see that the standard deviation at 12.8% is less than the standard deviation of both either of the single portfolios. And the Sharpe measure is a combination of return and risk. And it's kind of like the standard of, is your portfolio doing well on a risk-adjusted basis? You can see that the Sharpe ratio is highest on this mixed portfolio. So it's definitely, over the long term, international investing has worked. So one thing to take to consider is value investing abroad. So the basic value investing metric is the price to earning ratio, though it gets more complicated than that. And value investing has performed poorly over the past decade, as all these growth stocks in the US have really performed very well. So valuation metrics abroad do look more attractive, and this is something to look into. However, I would caution that in different financial systems, the PE ratios may trend in different directions. So it's definitely not certain that they will match up. So like I was saying, what to do now, it's definitely a good time to look at foreign stocks and maybe add a little bit of that to your portfolio, or think of a different strategy. Because of the long-term cycles, look like it might be a turn that the cycle is changing. Interest rates are equalizing across the growth, and there should be increase in foreign growth. I think because of the kind of unique nature of the COVID crisis, there will be countries across the world will be doing a lot of stimulating, even more than they did after 2008, because there won't be that debt overhang. And this should cause really international growth across the whole globe. And so what are the specific strategies that you can try? The first one to do is just long-term, broad-based, index investing. So just try to have a nice diversified index or funds that invest in many countries and just invest for the long term. If you want some more specific strategies, you can look at different countries. So a big question you see when people are doing international investing is to include China or not. So China has been the biggest source of international growth over the past 20 years, but there's a lot of political trouble there. It looks like there's a lot of debt, so people debate if this is a good idea or not. And there are specific investments you can do that will exclude China or include it. And then there's kind of specific strategies, like you can say, I just talked about value. You can also look at specific growth strategies like foreign small cap stocks.
Thanks, Alf. Great summary of what's going on the international side. I mean, it's an area that, again, I was talking with someone about the changes I've seen in the 40 years of doing this business. One about, first of all, information flows so quickly. There's a lot of information that happens very quickly. And I think sometimes it's bad because people build emotion into that decision. But the other big one that I've seen over the years is the change in which it's just not a domestic marketplace anymore. You do have to look across. It really is a world business cycle. I mean, there's sub-cycles in each country that's going on, but there's a world cycle that's also happening. So when we're investing, we're looking at more of what's going on a world focus than we ever did in the past. And you will talk about some of the administration policies. There's no doubt that we did see some policies under the previous administration that were pretty tough on some of the foreign trade. Whether you agree or disagree with it, I think there was a balance of good and bad in everything that we do. And what we saw was it did change kind of some of the relationships we had, especially with China. And Alf mentioned a little bit about China. Now, actually, Alf lived in China for about 10 years. So he really is our internal expert on what's going on over there. What we saw that, China does take advantage of certain technological and certain ways that they do business. What happened is that we played hardball with them, but it did change the environment of how we negotiate with other countries also. So there's some things that we have to look at what's going to change as we go forward. Our last poll question, first of all, What are you feeling on the new election? Are you positive on what's happening with the new administration? You're negative or you're neutral? Again, we don't care. We just look at facts, but we are curious to see what, I know we did this earlier today, and I think it's going to turn out pretty much the same here. It's about a split world right down the middle. Even our survey pretty much indicates what the polling has talked about over the last period of time and how the election happened. It's pretty much split down the middle of what people think. The bottom line is, what is it going to do to the facts as we look forward? Now, I want to kind of start wrapping things up a little bit, but I do want to spend just a second on what's happening with what's going on with the new administration. I mean, a lot of people are asking us, how should we invest with what's going on politically? Well, first of all, look at economic fundamentals. Where are we at in the business cycle? What's happening in the business cycle? What's going on with the virus? Those are the things that are really going to drive it. Now, there's no doubt that certain policies are going to affect certain industries, our debt, and some of those types of things, taxation. They will be part of our decision-making process. But the key is, we know what your risk is. You know what your risk is. You know how your goals are being achieved. We set up a well-diversified asset allocation to take advantage of what's going on with whatever administration's in the White House. One of the things that I am going to mention is volatility. That is something I don't think is going to go away. I don't care who's in the White House or who's running the country. One of the areas that we do see is volatility is more of a given than it's ever been. And a lot of that has to do with information flowing so quickly. We get a lot of reactions to things that are put out, whether they be fact or fiction. It does cause a lot of volatility what's going in the market. So you have to be cautious not to overreact with emotion to short-term types of things as far as announcements. But the key to what we look at is our monetary and physical policy. What is the Federal Reserve going to do? How easy is it to get money? Because they're going to determine the interest rate environment many times, what's happening with interest rates. So when we look at monetary policy, what is the Fed doing? How easy are they making it to get at money? The second thing is what the government's doing. That's the taxation. That's some of the things we see with debt, what we're spending. We have to monitor those social policies. Again, I try to be cautious here from the standpoint of a lot of these things, honestly, don't affect what's going on in the economy. These are more emotional issues that you might get excited about personally, and that's, but we have to see how is it affecting the portfolios we manage. Some issues really don't, and you have to take that into account. And how is the markets going to react to these things? As we're going forward, there's no doubt we are going to see an increase in taxes for certain people. They're talking $400,000 of income or above. Again, will that affect a lot of the people that we deal with? Not necessarily, but that's what we're hearing talked about. We'll see how that plays out. We'll see certain things as far as various deductions and stuff like that. Are they going to be changed? Are we going to change the cap on FSCA? Right now, a person's capped when they make so much income. They're talking about maybe eliminating that. There's a lot of talk. Well, we have to figure out what's going to be reality as time goes on. We don't know. I mean, that's the bottom line. What we can do is manage according to the rules we know now. I do know that also certain asset classes are going to have more advantages going forward, just the fact of life. When you look at, we talk about the energy industry. What are we going to look at that's going to give us some advantages when we're setting up the portfolios? What's going to take advantage of what's going on? You start looking at infrastructure. We're talking about a big infrastructure spending bill. What companies are going to take advantage of that? Those are things that are logical. And you look at taking the portfolios and adjusting them somewhat accordingly, never going too much into one style. If you have any questions, please let us know. We do have the ability through the Zoom meeting for you to submit questions. I know we have a couple that have flowed through, and I'll ask those at the end here, but if you have any, please do that. We always want to let you know, for current clients, we're reviewing your portfolios on an ongoing basis. If you're not a current client, I know we have a couple people that are on the webinar that are not. Feel free to, if you ever want a second opinion, you ever want to see how much risk you're taking in your portfolio, we'd be more than happy to look at it. And if you have anything else that you'd like to hear about, please let us know. It's very important. We value your input. If you'd like to see other types of webinars, that is a key item for us. You will receive a quick Zoom survey and follow up to this. We'd like you to fill that out and send it back in. We really appreciate it. I do want to take a second and just, Alf and I will take a couple of the questions that we received. Alfred, I'll actually throw this one out to you first. Someone asked, what difference does it make if the dollar's weak or strong? What's your thoughts on that one?
Well, it's like so many things in economics. You know, there's on the one hand, on another hand story. So for consumers, if the dollar weakens, that will cause imports to be more expensive. So the main one that you still see is gasoline, because oil is traded internationally. So if the dollar weakens against other currencies, that will make oil more expensive and therefore gasoline more expensive. And that'll happen with other products that have a lot of imports in them. So that'll be a hurt. But on the other hand, if the dollar weakens, people in companies that do a lot of imports will have more business, and so that will strengthen them. So there might be more jobs and more revenue there. So you really have to look at the details of the situation and kind of, especially when you're investing, what kind of companies are investing in? Are they more consumer focused? Are they more export focused? That kind of thing. So that's why the dollar matters.
Okay, thanks. And it is something, it's relevant. It is a fairly logical thought process. If our dollar weakens, it does affect import-export types of things that we do. I mean, it's a logical thing. If it's cheaper for people to buy things from us because our dollar isn't as strong, it's going to change that ratio. And another part that is important, remember, one of the stats that I've seen over the years, and I haven't seen an updated one as of the last year or so, but I think it's still pretty accurate, is that, remember, the S&P 500 stocks, 55% of their revenue comes from selling to foreign markets. So that's a really important note, is when you're talking about, so even if you just own some of the big name stocks, you're still owning internationally because they're selling on an international basis.
Yeah, you've got that exposure.
Yeah, you think about it, what happens is, you look at our society, we are actually a declining population society. As the baby boomers work through and we start dying off, what happens is there's less and less consumers that we have. So it is logical that we are trying to sell to the rest of the world, the same as the rest of the world's trying to sell to us. So we do see that it is important that, and the dollar will ebb and flow a little bit and kind of change those ratios. Another question we had was, if interest rates go up, should I be worried about my bond holdings? I'll start that one. Yeah, yes, it is something that we do have to think about. Now, we can control that. Remember, with all these things we're talking about, one of the things that we spend a lot of time in our diagnostics is really stress testing to say, if this happens, what's it going to do to your portfolio? So one of the numbers we know on the bond side is a thing called duration. A fancy word for us to say, we have an idea if interest rates go up a certain percentage, what it's going to do to your bond holdings. Again, it's not a complete science, but mathematically, it's a fairly good indicator. What we do is we see interest rates, if we think they're going to rise, we lower down the maturity, we lower down the duration. If we think interest rates are going down, we're willing to go longer, we're willing to take a longer duration of the bond holdings. But it is important that you do understand what that is. Again, another question, if you're managing your own money or somebody's managing it for you, they should know what the duration of your portfolio is fairly quickly. They should know what your risk is, and they should know the duration of your bonds because they can be affected. Also, you need to understand the quality of the bonds you're in, because just because you're in a bond doesn't mean it's putting money in the backyard. Bonds do have risks involved with them besides interest rate risk. There's also the risk of default. So you do have default rate risk. So as an economy is not doing well, you have to be cautious of which bonds you're holding. So bond asset classes to me are one of the areas that you really need to look at and not just think it's autopilot with those. Comment, Alf?
Yeah, I just add that, especially with the way the Fed has been going for the past 10 years, where they're very data-driven, interest rates are very unlikely to rise significantly unless there's also very strong economic growth.
Yep.
So you can be, your stocks will probably, have growth in there, even if you do lose something on your bond portfolio. So keep that in mind if you're worried about something like that.
Yeah, probably the worst time we had on that point was that 07, 09 period, because you didn't know where the bad bonds were. And
Yeah.
you saw equities go down. There wasn't a lot of places to hide at that time. That was one of the tougher times I've seen in my 40 years of managing money, because in the past, I maybe had gravitated to bonds because I thought that the markets were getting a bit on the high end anyway. And that time was tough because you didn't know where the bad bonds were. And we saw a lot of bond holdings and bond funds deteriorate in value because of that. So that's a great point, Alf. That's it for the questions we have. The last closing one I have is if you know of anybody that is looking for a financial firm that does a lot of financial planning, very active asset management. We appreciate referrals. We've built this firm off of referrals over the last 11 years. It's hard to believe it's been 11 years since I started Oaktree Financial Services. We have some great people here, Alfred being one of them, deep knowledge and a lot of years of experience in doing this. It's a very personalized approach that we have, and we're very proud of that. I really appreciate everyone's time this evening. I know it's a commitment, and we ran about an hour with questions. And I thank you for your time. If you have any questions, feel free to tap your advisor on the shoulder, give me a call. We're more than happy to answer those. And thanks, and have a great evening.
Yeah, thanks for coming, everyone.